Every morning, millions of Americans wake up believing they're investing in their future, that their 401k plans are the path to a secure, peaceful retirement. But what if the system that promises financial safety is designed to benefit someone else? What if your retirement account, the one you trust to grow with time, is actually fueling Wall Street's profits more than your own? Today, we're going inside the retirement model to uncover how the 401k system became one of the most misunderstood financial mechanisms of our time. The story begins in 1978. Congress quietly passes a new tax provision, Section 401k of the Internal Revenue Code. Originally, it wasn't meant to redefine retirement. It was a small clause allowing executives to defer part of their salary into tax-free savings. But by the early 1980s, clever consultants and corporate lobbyists realized something big. This clause could replace the traditional pension. Pensions, or defined benefit plans, guaranteed retirees a fixed income for life, paid by their employers. Companies carried the risk. Workers enjoyed security. Then came the shift. The 401k offered an alternative. Employees could contribute their own money, invest it, and hope the market would grow it enough for retirement. It sounded empowering. But in truth, it transferred the entire risk, from corporations to individuals. The structure was simple, at least on paper. You contribute a portion of your paycheck, say 6%. Your employer might match part of it. That money goes into investment funds, often managed by big financial institutions, mutual funds, target date funds, or ETFs. The government doesn't tax that money up front. It grows tax-deferred until withdrawal. Sounds like a win-win. But here's the catch. Every dollar you invest generates fees. Management fees, administrative fees, transaction costs, each one shaving a small percentage off your returns. It seems minor, maybe 1% or less, but over decades, that 1% can consume nearly 30% of your total earnings. And who collects those fees? Wall Street. When you buy into a 401k, your money flows into mutual funds run by large asset managers, companies like Vanguard, Fidelity, and BlackRock. They control trillions in assets. Every time the market moves, they earn from managing your money, whether you win or lose. Your savings are their capital. Your patience is their profit engine. And while you're told that time in the market beats timing the market, Wall Street quietly collects management fees year after year, rain or shine. Here's what's even more remarkable. According to studies, nearly half of 401k investors don't understand what funds they're invested in or how much they're paying in fees. The illusion of ownership, that this is your investment, hides a deeper truth. You own the risk, but not the control. For decades, Americans were told, if you work hard, save diligently, and invest early, the 401k will reward you. But this narrative carries a psychological trick, one that economists call the risk shift. In the pension era, companies carried the burden of guaranteeing retirement income. In the 401k era, the burden shifted entirely onto you, the worker. If markets crash, if inflation rises, if you live longer than expected, those are your problems now. A 2023 Federal Reserve report revealed that 1 in 4 Americans have no retirement savings at all, and nearly half feel they're behind schedule. Yet the financial industry continues to market 401ks as the gold standard of financial planning, because as long as money flows in, Wall Street earns, regardless of whether you retire rich or retire broke. Let's do some simple math. Suppose you save $300 per month for 40 years, earning an average 6% return. You'd end up with roughly $575,000. Sounds solid, right? But now factor in inflation. At a modest 3% per year, the real value of that $575,000 drops to around $200,000 in today's dollars. Now subtract management fees, taxes upon withdrawal, and healthcare costs in retirement, which can exceed $300,000 for an average couple. Suddenly, that secure nest egg doesn't look so secure. Meanwhile, mutual fund managers continue to earn billions in fees annually. In 2024 alone, The U.S. retirement fund industry generated over $7 trillion in assets, and Wall Street took home a large share in administrative and management revenue. In the 1980s and 1990s, as corporations phased out pensions, they pitched 401ks as a symbol of freedom. You control your future. It was a brilliant marketing strategy. It tapped into American values of independence and self-reliance. But beneath that message was a quiet escape. Employers freed themselves from the long-term obligation of supporting retirees. A 401k plan costs companies less, shifts risk away, and provides tax advantages. For Wall Street, it meant a steady stream of investment capital flowing in every payday, automatic, predictable, and profitable. How do other nations handle retirement? In much of Europe, pension systems still play a central role. Governments or employers guarantee a base income tied to wages, not market performance. For example, in Germany, retirees receive about 48% of their average lifetime earnings through a public pension. In Australia, a government-supervised superannuation fund ensures low fees and employer contributions. In Japan, there's a combination of public pensions and company-funded plans that maintain stability. The U.S., by contrast, relies heavily on individual market exposure, where personal decisions and Wall Street's behavior dictate retirement outcomes. It's not a safety net. It's a gamble. Today, over 60 million Americans have 401k plans. Yet the average balance for those approaching retirement, aged 55 to 64, is just around $180,000 financial. Experts estimate most retirees will need at least $1 million to maintain a modest standard of living for 20 years. That gap between expectation and reality defines the silent retirement crisis. And still, the system keeps expanding. Wall Street continues to market complex funds, target date portfolios, and robo-advisors, all designed to look innovative, yet often carry hidden layers of fees and limited transparency. Let's ask the question plainly: who truly benefits from the 401k model? Not the average worker who faces volatility, inflation, and uncertainty. Not the middle class who's forced to invest just to avoid falling behind. It's the financial industry, asset managers, consultants, and fund administrators who gain steady, low-risk income from the very people trying to save. When markets rise, they win. When markets fall, they still win. The system, in many ways, isn't broken. It's working exactly as designed, but not all hope is lost. Understanding the system is the first step to mastering it. Workers today can demand transparency in fees, better employer matching, and financial education that demystifies. Investing legislators can push for universal retirement accounts with capped fees and guaranteed minimum returns, similar to models in Europe, and individuals can diversify beyond 401ks into IRAs, HSAs, or low-cost index funds directly, cutting out middlemen. The future of retirement shouldn't depend on Wall Street's quarterly performance. It should depend on real, sustainable wealth building for everyone. The 401k was meant to empower. But over time, it became a quiet machine, transferring wealth upward, one paycheck at a time. It turned retirement into a market product and security into speculation. So the next time you hear someone say, "I'm investing for my future," ask, who else is investing in it, and who's profiting most from it? Because understanding inside the retirement model isn't just about money. It's about reclaiming control over the future that was promised and perhaps sold.